Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. We want to let you know that starting on Monday, September 28th through October 11th, there is an open access time on investors.com. So it's a great opportunity to come and check out our subscriber-only products for free. Just jump in, start testing them. Plus, we have some really nice discounts on IBD, EIBD, also our top-rated stocks under $10, and our e-tables list of stocks. So this is a great opportunity to come check that out, and that starts on Monday.
And I will be teaching the Level 1 workshop in Los Angeles next weekend. So come and see me. We have a lot of folks in the LA area. Come on out and let's have a good couple hours of learning.
All right, so for this week, we're going to jump into part 2 of our series on how to spot the chart patterns that launch big price moves. And we're also going to take a look at a stock you all know and talk about how the stocks run into two lines of defense, the 10-week and the 40-week moving average.
But first, Matt is going to take a look at the market.
Amy's in Phoenix for a workshop Saturday, so we recorded the rest of the show on Thursday. But let's take a look at what the indexes look like at the close on Friday. The NASDAQ added to the technical weakness that we'd already been seeing in recent weeks. Following the flash crash on August 24th, the NASDAQ tried to reclaim the 50-day line on September 17th, but it just bumped its head and came right back down. And then it continued further south this week. Also note how the 50-day line is trending down and may slip below the 200-day line. It's a clear sign of weakness when the shorter-term moving average is below its longer-term sibling. And as Paul Whitfield noted in the big picture, the NASDAQ may be on its way to undercutting the closing low from the day of the flash crash. It closed around 45.26. A break of that price point could turn out to be positive if it shakes out weaker holders and clears the way for a more confident rebound. Now, one of the major stories of the week was the sharp sell-off among the drug makers and biotech stocks, and that came after Hillary Clinton sent out a tweet accusing Big Pharma of price gouging. On this daily chart, you can see how Valeant Pharmaceuticals got hammered on Monday and headed lower from there. On Tuesday, Clinton outlined her plan for capping the out-of-pocket costs of prescription drugs, and investors were particularly concerned about the impact on Valeant because her plan could potentially punish companies like Valeant that focus more on acquiring drugs rather than developing them through internal R&D. And the big spikes in volume reflect that concern among institutional investors. Volume for the week was over 140% above average. Now, a little bit later in the show, we're going to get into how to use moving averages as lines of defense. And you can see that Valeant failed to hold the 50-day line, and although it did originally look like it was going to find support at the 200-day, it ended up slipping below that benchmark as well. But Valeant was hardly alone in its market misery. Biogen, Gilead Sciences, Amgen, Regeneron, and many others also sold off. Of course, it could take time for these stocks to recover and bounce back, but don't completely write them off. Many biotechs and drug makers have solid fundamentals and they have promising products in the pipeline, so continue to keep an eye on them. On a happier note, check out the chart for Nike. It was like Jordan in his prime. The stock bolted out of a base on Friday after beating on both earnings and sales. It gapped up to close nearly 9% higher on volume 366% above average. Of course, keep in mind that buying any breakout in this kind of market can be risky. With the increased selling pressure that we've seen, it makes it hard for any stock to make a sustained climb. But things can change quickly, so stay engaged and make sure that you keep your watch list up to date. And be aware that we do have a few IBD 50 stocks scheduled to report soon. We have Cal-Maine Foods, Constellation Brands, and Global Payments. And further into October, Q3 earnings season will really start to kick into high gear. Today we're going to get into part 2 of our series on how to spot the chart patterns that launch big price moves. And if you missed part 1 from last week, you can still see that on our website at investors.com/investingshow. Now this week, what we want to get into is the idea that there are 3 core concepts that you need to understand about charts in order to make sense of these chart patterns.
Now, chart patterns are areas of price consolidations that are necessary before a stock launches a move. The Space Shuttle had a huge launching pad.
Of course.
Yes, and we're going to talk about what makes a better launching pad in stocks. What are some of the characteristics that you're going to look for? So a stock will either be trending higher, and this is what we want to see, or a stock is trending lower. That's not exactly what we want to see, unless you're shorting a stock. And
Right.
then the third possibility is that a stock is trendless. It could be choppy or just plain old flat.
Okay, so when you're looking at a chart pattern, it should be part of a generally upward moving trend. The second key point we want to talk about is make sure that you're looking at both the price and the volume when you're evaluating a base.
So we need a solid trend. It's much easier to tell which direction a stock is moving in. That's number one. And Matt mentioned volume, and that's absolutely key.
Critical.
So here we have Ambarella. This is a 2014 in August in the breakout. Now, on the left side of this base, you often see the big spikes in downward volume. As a stock is forming the left side of the base, this is normal. On the right side of the base, you want to see the accumulation or the upside blue spikes in volume, showing that the pros are beginning to pick up shares.
And if you're fairly new to charts, just understand that they tell you a story. And one of the stories you want to know is, are these fund managers aggressively buying or selling the stock? Now, you can't tell how serious that buying or selling is until you look at the price and the volume together. And if you look at the volume in the handle for Ambarella, it's generally been lighter on these down weeks than it was on the prior up week. So that shows you that selling is not particularly aggressive.
And the upside spikes in volume were increasing weekly prior to the breakout. And the week of the breakout itself, from the price consolidation, volume increased 174%. And after the breakout, there were 3 weeks of above average volume, showing the professional buying that was coming into Ambarella.
So the first two concepts you want to focus on are what's the trend, and you want to make sure that the stock is in an upward trajectory. Second, check the price and volume together so you can see if these large investors are in buying or selling mode. And that brings us to the third concept about these chart patterns, and that is support and resistance.
Well, price consolidations are similar to boxes. And a famous trader who made this concept really easy to understand was Nicholas Darvis. If you have not read his book, you absolutely must read it. It's How I Made $2 Million in the Stock Market. And Matt, this was many, many years ago. So $2 million at that time was probably like $20 million today. So in How I Made $2 million in the Stock Market, and we said it's well worth reading, Nicholas Darvis said that he looked for boxes. And then imagine that a ball was bouncing around inside that box, okay? And when he bought was when that ball bounced out of the box on big volume.
And here's what that looks like on a chart. The top of the box is created by the prior area of resistance, and the bottom is formed by the recent area of support. And not to mix metaphors too much here, but you could also see this as a ceiling of resistance and then a floor of support.
Absolutely. Ceiling and floor is the easiest way to understand this, I think. Apple is a great example of a stock forming a box or a prior consolidation in August 2004. And remember, this was the year of the iPod. Imagine a ball bouncing around in that box, and then it broke out on above average volume, and afterwards, it really got some huge monster spikes in volume, showing that the institutions were piling in. And after the breakout, Apple was up 13 out of 14 weeks in a row.
Right. So think of these three concepts that we've been discussing. Apple was trending higher as it formed that consolidation, and it had established a floor of support and was climbing back up towards this prior ceiling of resistance. And that's the testing ground. And that's why we use that prior point of resistance to determine the buying point or the entry. And as Amy said, Apple punched through that ceiling on unusually heavy volume.
And this is what Bill O'Neill, who is the chairman and the founder of IBD, jokingly refers to as, this is not your Aunt Sue buying.
Definitely not. Or you're lucky if it is your Aunt Sue buying, and maybe she'll leave you some of that money. Now, one more example of this is Avago Technologies, which is a chip designer that has benefited from the popularity of Apple's iPhones. It established areas of support and resistance in in this base, then broke out of the pattern in September 2013 to launch a huge move.
And on December the 20th, Avago gapped up 13% with volume increasing 137% for the week. And it continued to move higher beautifully after this, and it formed a series of other bases or price consolidations along the way.
So keep these three concepts in mind as you review a chart pattern. What's the trend? What story is the price and volume action telling you? And where are the lines of support and resistance?
Now, next week on part 3 of this series, we will take a look at the cup and handle base and what to look for. Mm-hmm.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
There are two lines in the sand that we're going to talk about today, and these are areas where the professional investors come in and support their positions. For us as individual investors, it helps to follow these two key moving averages. One is the 10-week line, and the other one is the 40-week line.
So when you're evaluating a stock that you already own or one that you're thinking about buying, make sure you look at these two lines, and that will help see if fund managers are in a supporting mode or if they're more into a selling mode. So let's see what that looks like with a weekly chart for Valeant Pharmaceuticals from 2012.
Now, the stock formed a double bottom base that was fairly tight. Sometimes this pattern can be a little bit more wide and loose and a little bit more violent.
Which usually reflects what's going on in the overall market.
Yeah, it's a sharper shakeout than the other bases had. Now, take a look at the left. It formed a cup-shaped base, and it gapped up and zoomed 16% on volume that was 99% above average before it took a breather and formed the double bottom base.
And as it formed the first half of that pattern, notice how it tested the first line of defense, the 10-week moving average line. And on the week ended November 9th, 2012, it fell below that benchmark. But Valeant did find support at the second line of defense, which is the 40-week moving average. So that, plus the generally tight trading, was a sign of institutional support.
And it moved back above the 10-week line before the breakout. And the week of the breakout, volume was average. That happens sometimes. But then volume really kicked in the week of January the 4th. And notice how the stock hugged that 10-week line as it rose higher. Institutions were supporting the stock at those price levels. So it made a really nice move until it formed a flat base in October and November and December.
And it makes it so much easier to hold a stock if it does find that support.
It does.
So when you're watching a stock that you already own make a run, if it's finding support at the 10-week line, it makes it much easier to hold on to it for even bigger gains.
And we should say that if you look in the model stock of big winners, a lot of them hug that line so beautifully. Or they might dip below the 10-week line a little bit to form a base, but look for those 10-week huggers.
Right, and they don't live below
exactly.
that 10-week line. And for more info on how to use moving average lines and other chart reading lessons, visit IBD University on investors.com. So we want to remind you that open access starts this week, September 28th, Monday through October 11th. It's a great opportunity, if you're not a subscriber to our different products already, to come try them out for free.
And we will have a link to a great article that was in the paper this week, talked about Jack Dreyfus. Now, when I interviewed Bill for my book, How to Make Money in Stocks Success Stories, Bill told me that he really admired Jack Dreyfus a lot, and he learned a great deal from him. So
one of his chief mentors. Really.
It was. So read this Leaders and Success story. It's really terrific. We'll have a link to that on our website at investors.com/investingshow.